We're diving straight into a very high-energy financial analysis report. It's arguing for a strong buy on ABTC, American Bitcoin Corp, and it's projecting a massive 124% upside to a $4 price target.
That's a huge call.
It is. The core drivers are pretty clear: new analyst coverage, their Bitcoin treasury, and some just phenomenal revenue growth. Let's start the critique.
Okay.
So, what I think works really well right off the bat is the focus on this new MicroStrategy narrative. It frames ABTC as this high-octane trade because they're hoarding Bitcoin. We're talking 5,098 of them.
Not selling them like other miners.
Exactly. They're not selling to cover costs, and positioning that as a contrarian signal it's a really great hook. The analysis also leans heavily on the urgency of the Roth MKM coverage and some hard data, like a 400% year-over-year revenue surge. It feels significant.
That foundation is compelling, definitely. And the narrative, that they're bucking the trend, that's powerful. I do wonder, though, if we fully substantiated the financial integrity of that contrarian signal.
What do you mean by that?
Well, the report states ABTC is hoarding all this BTC, while competitors are selling to pay bills. The implication is that they're just in a stronger financial position.
Right.
But the connection between that huge 400% revenue surge and the actual financial capacity to maintain or even grow that treasury, it's largely implied. It's not spelled out.
That's an interesting point. I mean, the high-level view seems strong, right? 400% growth lets them hold the Bitcoin. For a high-energy alert like this one, does it really need to slow down and dissect gross margins or cash flow?
I think it does.
You think that would risk overcomplicating it? Losing the reader?
I actually think it risks undermining the entire narrative if it doesn't. The target for this kind of analysis is pretty sophisticated. They know top-line revenue growth isn't the same as profit.
Good point.
That 400% jump could be coming from, say, expensive debt to fund an expansion. Or maybe they're just sacrificing margins to get there. If the company is selling off tons of new equity or using high-interest leverage just to buy and hold that Bitcoin,
then it's not a contrarian signal.
It's a highly leveraged gamble. And smart investors will spot that immediately and, they'll discount it.
So the weakness isn't really a lack of data, but a lack of a clear financial bridge between the operational success and the treasury strategy. The implication alone just isn't enough for real conviction.
Exactly. The analysis report is leaving this crucial gap between the growth stat, that huge 400% figure, and the long-term decision to hoard the 5,098 BTC. If they have to dilute shareholders or take on a mountain of debt to keep that treasury.
Then the new MicroStrategy claim just falls apart. It's built on leverage, not sustainable earnings.
Precisely.
So how do we fix that? How do you build that bridge without getting bogged down in what feels like an annual report review?
We need to strengthen the material by explicitly connecting those growth figures to some kind of operational efficiency or cash flow metric. That's what provides the foundation for the new MicroStrategy claim. It shows the strategy is financially disciplined.
Okay, give me a concrete example.
Well, instead of just stating a revenue surging over 400%, you add some context on the quality of that revenue. A simple way could be adding a brief line explaining that the new mining fleets coming online have, say, a high enough gross margin to fund CapEx and allow for the strategic accumulation of the Bitcoin.
Okay.
That one detail immediately makes the contrarian signal robust and verifiable. It validates their whole strategy.
That single line really does shift the perception from just high-risk growth to disciplined, self-funded capital allocation.
It does. And another really actionable way to improve this would be to clarify how that 5,098 BTC was acquired in the first place.
Right. Was it debt? Equity?
Was it purchased with debt, through dilutive equity offerings, or from retained earnings from that 400% surge? That choice completely alters the risk profile. If the material can just briefly state that the treasury was funded entirely through retained earnings, for example.
That dramatically strengthens the argument. It proves ABTC is a financially superior operator.
Exactly.
Okay, let's move on. We've established the treasury narrative. Now we need to make sure that financial discipline translates into that massive price target. The whole centerpiece of this analysis report is the 124% upside, that $4 target.
The main hook.
The main hook. And as I see it, the argument for why that target is valid relies heavily on technicals. The stock is having a volume breakout above 175, and the next resistance isn't until 250.
That makes perfect sense for, initiating a trade and riding momentum. But is the connection between the core catalysts we just discussed and that ultimate valuation target, is it fully established?
What do you mean?
I mean, the $4 target is the headline. but the analysis seems to lean on technical levels and an external analyst call rather than detailing the underlying financial model that justifies $4 specifically.
Well, the report is designed for urgency, right? If a technical breakout over $1.75 suggests $2.50 is next, isn't that enough for an aggressive, short-term trade alert? Why complicate it with valuation modeling?
Because the target isn't $2.50, it's $4. That's a 124% leap. Technicals are great for entry and exit points, but they don't justify a massive long-term valuation premium like that.
So you're saying for the stock to actually hit and sustain $4, the market needs a fundamental internal reason.
Yes. The report gives us two huge financial drivers, the 5,098 BTC Treasury and the 400% revenue growth, but it never actually translates those internal metrics into the external $4 target.
So the weakness is a critical disconnect.
Exactly.
So the $4 headline lacks its own proprietary weight.
That's it, exactly. And that disconnect weakens the claim that the report has its own internal justification for the upside. Without some kind of model, the target just feels like an analyst's headline they're repeating, not a conclusion they drew themselves from the company's own operations.
So the suggestion is to introduce a high-level model. But how do you do that quickly in an urgent alert? You can't just embed a full DCF analysis.
No, of course not. You just need to introduce a brief, high-level modeling framework, something that links the two core value drivers, the BTC holdings and the revenue growth, directly to that $4 target. It just anchors the analyst rating in the company's actual financials.
Okay, what would that look like in practice?
One simple way is to mention how the $4 figure could be derived using a sum of the parts valuation. You could argue for valuing the Bitcoin treasury at a slight premium to its net asset value.
Given the market excitement around these BTC hoarding companies?
Right. And then you separately apply an appropriate forward multiple to the projected revenue growth from the mining operations. This just shows the target is calculated from verifiable parts, not just copied from a press release.
That's a powerful way to add rigor instantly. You're showing the target is based on two distinct pools of value, the static asset pool and the operational growth engine.
And to build on that, another great example would be to circle back to the Satoshis per share metric, which the material wisely introduces.
Ah, the SPS?
Yes. Instead of just stating the SPS growth, you explain how that 17% monthly growth correlates directly with the valuation methodology analysts use to get to $4. You could say something like, analysts assign higher price-to-sales multiples to miners who show superior accumulation of Satoshis per share.
So you're explicitly connecting SPS growth to the price target. That makes the whole analysis feel more complete and, well, proprietary.
It does.
Okay, I see how those additions would elevate the financial rigor. Let's pivot now to tone and style. The tone is explicitly defined as high energy, urgent, bullish, contrarian. It's trying to grab attention with phrases like stop scrolling or calling the stock a rocket ship.
Which is a reasonable strategy for getting eyeballs, sure. But what are the potential downsides to relying so heavily on that kind of high-octane emotional language?
You're asking if there's a risk it overshadows the data?
Exactly. While you need urgency for an alert, does this style actually undermine the sophistication of the financial points being made?
I think the intention was just maximum engagement and a clear call to action. I mean, if the facts are solid, and we just talked about how to make them more solid, why not use dynamic language to cut through the noise?
Because the highly urgent and frankly speculative language, phrases like powder keg waiting to explode or load the boat, it risks reducing the impact of the really sophisticated claims.
Like the fact that they're in the top 20 of publicly traded Bitcoin treasuries.
Exactly. Or the detailed tracking of Satoshis per share. That language can make the whole thing sound less credible to an informed observer.
So the language is alienating the very audience that can appreciate the financial mechanics we just detailed. It sounds too much like retail hype.
Precisely. It diminishes the credibility. The material needs to calibrate its urgency. You still want to use powerful descriptive language to highlight the significance of the facts.
Emphasize the gravity of holding almost 5,100 Bitcoin.
Yes, but dial back the speculative exhortations. Rely more on financial terminology to maintain a perception of robust analysis. You want the facts to generate the excitement, not just the delivery style.
Okay, give us some actionable examples. How do you upgrade the language but keep the bullish conviction?
Instead of ending with a phrase like, load the boat, which is purely speculative, you could frame the conclusion as an assessment of asymmetric risk to reward.
Ah.
That's a sophisticated summary. It tells the reader the potential upside is disproportionately larger than the calculated downside. It's the professional way of saying, this is a must-buy.
That's a great example. You keep the bullishness and the urgency, but you upgrade the analytical language to match the financial depth.
And you can replace generic superlatives like rocket ship with more analytical yet still bullish phrasing. Something like describing the position as a highly leveraged exposure to Bitcoin's future appreciation.